Hi, good morning clients. Thank you for tuning in to our webinar this morning. It is about time, so I guess we will start right now. For this week, we will have updates from 3 sectors for you. First of all, we touch on the Singapore REITs update. After what we saw 2 weeks ago was the first rate hike for this year from the Fed. And then following which, we will also have updates from the coal sector and the Singapore banking sector. So without further ado, I'll jump right into the S-REIT update. We saw 2 weeks ago the first rate hike for 2018, and if we jump into the performance of the REIT index over this year, if you focus on the blue bar with me, you will see that the performance this year for the sector has been pretty lackluster if you look at what the sector has done over the past few years. So you look at the past few years, basically in most of these years the REIT index have actually outperformed the STI, and for this year actually is at a negative 5%. But after the rate hike on Wednesday 2 weeks ago, we saw that actually the rate hike has pretty much been priced in, it looks like, because there was pretty much a non-event for the sector. The sector actually was ended flat the day after the rate hike. And in fact, expectations even before the rate hike was already for 3 hikes this year. So, and the one that came in March actually was already much widely expected. So, but if you look at the performance this year, it looks like the index is kind of like pricing in the macro headwinds that could come this year, with the underperformance versus the versus both the STI index and the real estate developer index. So what happened on the Wednesday at the press conference for the Fed was that, I believe this was what we have covered in depth last Monday at our webinar, so I will not go too much in depth, but I think what is good to focus on is if you look at the red boxes that I have highlighted out, the expectations for GDP growth from the Fed this year and next actually was ramped up. In the December projection, it was 2.5 and 2.1 respectively for this year and next, and that forecast has been jacked up to 2.7 and 2.4. So an unemployment rate forecast was also down from 3.9 to 3.8 this year. And the thing to note is that while this GDP outlook has been raised by the Fed, the inflation forecast that they are looking out for this year and next has actually remained unchanged. If you look at the forecast they have for this year is 1.9, they have for next year is 2.0. So you are having this kind of growth at a decent pace, not too fast, not too slow, not fast to the extent that you jack up inflation, and then to the extent that the Fed has to increase the pace of rate hikes. So this is pretty much still the Goldilocks kind of situation that we have been in. Decent growth pace, tepid inflation, which should be good for REITs. And in fact, if you look at the probability of rate hikes, if you look at the left table with me, the red line, that is the probability of 4 rate hikes this year. That probability actually has gone down after the March rate hike 2 weeks ago, in part due to the Chairman Powell's comments reaffirming gradual rate hikes, and then he also mentioned concerns about the trade policies for businesses. So that being said, we still do think, as we have mentioned at the start of the year, that this year there could be quite a bit of upward pressures on yields, which could be a headwind for REITs. So we already do have the existing pressure points of the upcoming rate hikes, 3 expected this year, could be 4. And on top of that, this year we also have the Fed balance sheet tapering, which will intensify towards the middle and the end of the year. And additionally, we also have some of these other reasons, and some of these reasons are also the reasons which have caused the sell-off at the end of Jan, at the start of Feb, just before Chinese New Year. So you have, first of all, we have commodity prices rising. If you look at the Bloomberg Commodity Index, it's been on a gradual uptrend since July last year. There has been wage growth that is strong. In the figure that came out in January this year is the highest wage growth since 2009. So these two could actually stoke inflationary concerns as well. And as well as there were comments from the Treasury Secretary supporting a weak US dollar, which could also add to inflation. And you have the tax cuts from the Trump administration that could actually fuel further growth and possibly accelerate inflation as well. And lastly, we also have the announced 1.5 trillion unfunded infrastructure spending. So this growing deficit in the US is a concern, and that could actually drive up borrowing costs for them as well. So the concern right now from all these headwinds will be that when interest rates do go up, how much on the DPU front would be impacted for all these REITs. So using those that are under our coverage as a proxy, we see that I will show you a table later on, but you will notice that close to 80% of all the REITs have already hedged at least 70% of their debt on fixed interest rates. So given this very conservative hedging policies that a lot of them will have, because REIT managers will also be cognizant of the fact that interest rates are going up. So we have also observed that a few of them have been increasing this proportion of their debt that they have hedged on fixed rates over the last few quarters. So given this conservative policy and this you have it that 80% of REITs have at least 70% of their debt hedged on fixed rates. If we assume 100 basis points increase in interest rates, the impact to DPU based on the current hedging status will just be a -1 to -3% for 2018's DPU. But if you assume a zero hedging kind of situation, a hypothetical situation, that would actually, given that we all know that interest cost is one of the the largest costs for REITs, then you have it that the DPU will be negatively impacted from a range of -8% to -12%. This outlook for each individual sector, this is something we have covered multiple times this year, but just a very quick run through. I think if you look through all these sectors, most of them in the office space, in the industrial space, hotels as well, they generally face a positive scenario of tapering supply after the peak last year, and this easing of supply from this year onwards should actually build a base for rentals to start climbing, especially with demand right now expected to improve as we are seeing global economy start to recover. Okay, this is on the retail front. This year's supply, which is the blue bar, is expected to still be quite a bit. The red dotted line is the historical annual demand. So you see that this year's supply will be still more than the historical annual demand. So retail rentals are still going down. We expect them only to bottom sometime in the second half of this year. So because on top of this supply issue, you also have the threat of ongoing the e-commerce. We saw Amazon is coming in last year, and 2 weeks ago we also saw Alibaba increasing their investment amount in Lazada by 2 billion. So all in all, still kind of challenging. We expect rents to only bottom in the second half. These are some of the supply coming up. Office is doing a little bit better. 3Q last year it has already rebounded. The rebound accelerated in the final quarter of last year. So this year we are still expecting negative reversions for offices because renewing leases will mostly be signed in 2015. That is when the index peaked. But then rebounding rents right now, rebounding spot rents could actually mitigate or lessen the impact. Okay, so this year you can see the blue bar as the supply will be actually a lot less than last year and also a lot less than the historical annual demand. These are some of the supply coming up. Okay, for industrial, generally, we are seeing the same kind of situation, tapering supply only except for only the factory space subsector, where this year you will still see a little bit of supply, but thereafter you will also start to taper off. Rents are still falling for this sector. We are expecting rents to bottom by the end of this year, and similar situation of the fact that easing of supply this year should build a base for rentals to start climbing. Okay. So if you look at our table later on, which I'll show you, right now we have the accumulate calls we have on this industrial sector, where we have accumulate calls on Ascenders and cash. We are maintaining exposure to the business and science park properties and high tech, high specs buildings, because this is a strategic top-down play. We are actually positioning ourselves in the as Singapore evolves towards a higher value add manufacturing, and as we move towards the Smart Nation initiative. And the sector as a whole, we are still a neutral for industrial, subsector as a whole. We're still neutral. For us to consider an upgrade, we would like to see occupancies improve first before we actually will consider an upgrade for the sector. Hospitality, it is there are improvements on the operational front. You see that RevPAR turned positive after close to 4 years of mostly being in the negative territory. So towards the middle, sometime in the middle of last year, RevPAR actually has been steadily stayed in the positive range, and industry RevPAR was actually at a 2-year high. This year, we also have the return of biannual events in Singapore. We just had the Singapore Air Show last month, and on top of that, you also see that supply, along with what we saw for the office space and industrial space, will also taper off sharply for the sector this year. You see that 2014 to 17, the CAGR was about 5+%. Over the next 3 years, the CAGR will slow down to a much lower 1.4%. So these are some of the supply coming up. And if we look at the valuations for the sector right now, you see that using the yield spread as a valuation metric, we are currently doing a 2.9% for the yield spread. This is against a 7-year average of 3.7%. A lot of this yield spread compression also has come on the back of the rise in the 10-year bond yields in Singapore. So at this level of yield spread, you will see that the average historical post GFC, there has only been 2 instances where the yield spreads have compressed below these levels. Once in 2010 for a 2-month period, and then in 2013 for an 8-month period. So right now, as we are on this higher side of the valuation metric for this yield spread, and then given that the multiple headwinds that we think could come and the upside pressures on yields, we are advocating more caution. We still have a few accumulate calls. If you look at the this is a summary of the REIT sector, all the different subsectors, all the REITs that are listed here. You will see that our target prices are actually not too far off from what the prices are trading right now, even for those that are neutral. So I think if you are looking for stable investment vehicles, if you factor in the yields for all this at upwards of 5%, upwards of 6%. These will be stable investment vehicles as asset classes for this year, given that our target prices are pretty much quite close to what the trading prices are right now, even for those on a neutral call. So I think pretty stable vehicles this year. But if you are looking for a greater upside potential, I think we are still advocating a switch to the developer sector. So for the accumulate calls or buy calls that we have in the REIT sector, we, as mentioned, have Ascenders, Cash, and lastly we have Dasin on the StockFacts program. So you can see that right now the price to book on average for the various subsectors are trading at close to a one-time price to book. Okay, with that I'll pass on to Guangzhi and Paul for the various sector updates.
Hi, good morning. It's Guangzi here. So next we will talk about our coal sector monthly update. So over the past 2 months, there were some news update from both China and Indonesia market. So in China in March, the central government unveiled the government work report for 2018. So part of it was regarding to the further cut down the steel and coal capacity this year. As you can see here, this year the authority aims to curb 150 million tons of coal production this year, and it will also shut some coal-fired plants with a capacity of less than 300 kilowatt that fail to meet the emission standards. So according to this, we expect that the demand for imported coal, especially from Indonesia, will continue to grow given the ongoing supply side reform in the domestic market. So for Indonesian market, the Minister of Energy and Mineral Resources unveiled the adjusted pricing formula for the domestic sales to electricity sector for public interest. So basically, the new formula was set to was fixed at around $70 per $70 per ton on FOB basis, and the principle of this formula was based on the lower of the prevailing price, or $70 per ton. So that means if the current coal prices was trading at below $70, the sales price to those power plants will be based on the current prevailing price. However, if the coal prices are above $70 per ton, the price cap will be $70 per ton. So based on this adjusted coal pricing formula, we expect it will drive higher volume of exported coal moving forward. And also these relatively negative regulations will cool down the sentiment of the domestic investment in this coal sector. So next we will take a look at the indicators of the sector. So as you can see here, in the figure one shows that the monthly coal production in China was flattish, and for those imported volume in January and February surge, you can see there was a big jump over the past 2 months. So the reason was that there was a strong growth of power demand in China in January and February this year. So the reason behind this was due to several factors, and one of them was because the extremely cold climate in January and February, and the authority tried to persuaded the residents to use power or gas to generate heat rather than using coal previously. And another reason was because of the recovery of the domestic economy. So moving forward, we expect the power demand in China will have a stable growth this year. So the figure 4 shows that the domestic coal price in Indonesia, as you can see here, ever since July last year, the coal price was recorded at a consecutive 8 months growth. Now was close to 6-year high since 2012. So the figure 5 shows the current FOB spot price in Qinhuangdao. So you can see that actually the coal price dropped a little bit, but still it lied in the abnormal zone, which means that the authority will continue to cool down the coal price moving forward. In January and February also, the China's port coal inventory recovered a little bit, but based on year-on-year comparison, it was flattish. So these are the updates for the two counters, Golden Energy and Resources, as well as Geo Energy Resources. So basically, for these two counters, they will ramp up the capacity this year. For gear, it targets to sell 20 million tons of coal this year, and so far it had secured 13 offtake agreements for 50 million tons of coal sales this year. So we believe that it can achieve the FY18's target this year. And also, as of March 18, this is typo. As of December 17th, it has accumulated cash in hand of 189 million US dollars. So for Geo Energy, the story was almost the same. So it targeted to sell 11 and to 12 million tons of coal, and so far it also signed the offtake agreement with ECTP for 7.5 million tons of coal supply in this year. And also last year it already issued the senior note worth of 300 million US dollars. So as of December last year, the cash position reached 262 million US dollars. So for these two counters, we expect that there will be some M&As to announce for the rest of this year, since the cash position for each of these two companies was quite huge, and the interest rate for each of these two counters was quite high. So for Gear, the interest rate burden was around 9%. For Geo, the interest rate was around 8%. So definitely they will try to leverage the fund to improve the inorganic growth moving forward. So next I will pass on to Paul to talk about the banking sector update.
Hi, this is Paul here. Just to update everyone on some of the latest data coming out from the banking sector. Okay. Okay, on the first slide, just on Singapore, the two key indicators, loan volume. As you can see, loans has been decelerating. The February number, of course, was a bit weaker, about 3% plus, but due to the festive season, it's better for us to use the year-to-date, which is the combination of January and February compared to a year ago. So year-to-date to February, which includes January and February, loans growth is up 4%. This is still below the trend line of 2017, 7%. I think the market is probably expecting high single digit. On our forecast is about 7 to 8% loans growth for the industry. So so far it's been below pace. But more importantly, we do still, but in terms of the margins, as you can see on figure 2, we think there'll probably be some upside on margins for the banks in the first quarter results. As you can see, the red line, that's 2018 SIBOR compared to a year ago, which is the green bar chart, which is about 2017. So you can see there's probably a huge upside, at least year on year, for the margins for the Singapore banks. So that would be the big positive for the banks for first quarter 2018. Move on to Hong Kong at least. As you know, OCBC and DBS have a big exposure to Hong Kong. So this is some of the most recent indicators of what's happening to the Hong Kong banking sector. As you can see, loans growth in Hong Kong is still very vibrant. It's going about as 17 to 18%. The Hong Kong dollar loans alone are growing about 19%. The chart you see on figure 3 is a combination of Hong Kong dollar and foreign currency. So loans growth is robust, and not only is loan volume robust, you can also see in terms of the margins, the HIBOR is also much higher than a year ago. As you can see from the table, from figure 4, 2018 in rate is much higher than a year ago's HIBOR in 2017. So all in all, we will also expect strong numbers for OCBC and DBS Hong Kong division. Not only in loans but also in NIMs. So in conclusion, we still have buy calls on all the banks, but our preference is still on DBS and OCBC, due in particular to their exposure to Hong Kong in comparison to UOB, which does not have any exposure to Hong Kong. Okay, that's it for us. Any questions?
Hi, this is Te Hong here again. We had a question on yen lot. We don't cover yen lot, but then from what we gathered at the last results briefing, they were actually guiding for sales in this year. We all know about the slowdown in China property sales, but so in FY17 they actually guided for about 20 billion sales. They did 26 billion in FY17. And in FY18, they are guiding for 32 billion to 35 billion of sales. And I think if the unrecognized revenue from the already done sales will actually still pretty much support earnings this year. And the sell-through rate for them last year was also pretty healthy, about 75% versus the historical 80%. But in terms of target price and all that, we actually do not cover them. There is also another question on the latest flash estimates for the URA Private Property Price Index. So one good thing to note about that flash estimate is that this quarter-on-quarter growth of about I think it's a mid-single. Is it that number is actually the fastest quarter-on-quarter growth since 2010. And if you look at the 3% plus overall growth is actually led by growth in the core central region. So as we have mentioned in the a lot of our coverage as well, we see that firstly foreigners are coming back slowly, and then if for those of you who want to play on the recovery in the core central region prices, because right now what we have seen is that prices have mostly recovered. In fact, a lot of the price appreciations are mostly for outside central regions. You see a lot of these suburban projects whereby the selling prices have been a lot higher than the old, even for adjacent projects. So that's in the suburban areas, but the recovery in the core central region prices have actually lagged. It's only in the first quarter's data that we have seen that it's actually leading the recovery, and in fact the fourth quarter of last year's the price data was also it was also the CCR properties that were growing the fastest. So if for play on the CCR recovery, I think for those that are under our coverage, we have CDL. They are due to launch a new Futura, the second phase soon. First phase was doing very well at 3002 PSF average sale price compared to the Gramercy Park just down the road at 2008. Okay, and then so CDL is one of them, and CDL's Tapestry also sold about close to 40% in the first weekend, and the selling price was also about anywhere between 25 to 30% higher than the two adjacent projects beside it. There's the Santorini and the Alps. So CDL is one for recovery on the CCR prices, and the second one will be for Hobby Land for the Sentosa properties that they are holding. So for the play on the recovery in the CCR regions under our coverage will be these two, which we both have accumulate or buy calls on.
Hi, it's Guangzi here. There is a question asking about the coal sector, why the growth prospect is not reflected in the share price of coal-related counters. So our comments are, firstly, these two counters are quite sensitive to the coal prices, and right now the coal prices are still holding at a high level, so maybe the market is a bit nervous about the slight correction of the coal prices. And secondly, we do not forecast the big jump of the coal prices this year. We expect it will maintain the same level as last year's. And secondly, as we mentioned before, China will cut down 150 million tons of coal this year. the volume is equivalent to the amount that they imported from Indonesia in full year. So that means the domestic supply shortage will be supplemented by the imported amount. That means this domestic cooldown measures will actually drive more imported coal moving forward, and that is the positive catalyst for these two counters. So we think that the major catalysts for these two counters are still the growth of production as well as the inorganic growth such as M&As that they may announce in late this year. So all in all, we think the prospect of these two counters are still quite positive. Thanks.
Hi, there's a question for our latest target price for DBS and OCBC. So DBS, our target price is 29.30 versus the current price is about 7% upside. OCBC, our target price is 13.94 versus current price is about 9% upside. For the latest on our target prices, you can actually refer to our morning note, or you can refer to our website at stocksbnb.com, the link which you can see on this page right here. So if there are no further questions, we will call an end to this week's seminar, and we hope to see you guys again next week. Thank you.